Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great this morning. How about yourself?
Good, thank you. Today we're going to talk about diversification. We hear a lot of people out there, a lot of investors and clients. When we talk to them, they say, well, my portfolio is diversified, so I should be able to minimize risk. Unfortunately, I think a lot of people really don't know what diversification truly means. So we're going to talk about some of the basics you should look at when diversifying your portfolio. Also remember that diversification doesn't just pertain to the stock market. When we look at diversification, we take everything into account when it comes to your retirement planning and your investments. We look at real estate, whether it's raw land or rentals. We look at different asset classes such as cash and treasuries. We look at insurance-based products. We look at stocks, bonds, mutual funds. So when we talk about true diversification, we look at everything that's out there available, not necessarily that you have 2 or 3 different mutual funds in a portfolio, which are all driven by the stock market. So Tyler, let's talk about, like I said, there's a lot of levels of diversification, everything from asset classes to individual securities, different sectors. Sectors are even a great thing to look at when it comes to diversification. We'll see portfolios in here, and people, again, will have 2, 3, 4, 5 different investments in a portfolio. Maybe they're ETFs, maybe they're mutual funds, but the overlap in sectors is tremendous. So that really takes diversification away. But let's talk about these asset classes first and go a little bit more in depth when we talk about diversification.
Yeah, Dean, so there are, as you mentioned, there are many different levels of diversification. But first, I just wanted to touch on what you talked about before, where we see many people who come into our office and they think they're diversified when really they're not too diversified at all. Where there's been people that came in and they held one single mutual fund, a single large cap growth mutual fund, and they thought if the market went up 10%, they got the full 10%, but then when the market goes down 10%, they're wondering why they're down 12%. And here they're not properly diversified when they think they are. So we're going to get into that a little bit further in the show, what to do, how to get diversified, different techniques that work. But first off, there's many levels of diversification, more than many people realize. And the first would be asset classes. So asset classes are where we're going to start, and we're going to kind of branch down from there. But that would be equity is the first asset class, which would be stocks. Now, that's primarily used for growth potential. Individual stocks are going to be the riskiest investment that you can hold. And then after that, we have something called fixed income, which is known as bonds. So bonds are used for income and stability. They're perceived as safer than stock investments, but yet they can still lose money. They're still subject to different market risk, interest rate risk, different things like that. And then the last one is money market accounts or cash equivalents. So that would be, again, money market accounts, cash accounts, different things like that. And then you can even go further, like you said, Dean, where you go outside of the market into even fixed annuities, insurance products, stuff like that, where you can further diversify, even raw land, real estate, things like that.
Right, and throw into that conversation too commodity products and also precious metals. So I mean, there's a lot of opportunity for diversification, not just within mutual funds or ETFs or stocks.
Exactly. Good point there, Dean. And that's something that many people don't realize either. Commodities, gold, silver, that's a good to have a certain percentage of those in your portfolio at times, because oftentimes those are viewed as a hedge against different stock market risk, where typically when the market goes down, those different asset classes might go up. So again, that's the whole concept of diversifying. So we have the asset classes. Then from there, we have individual securities, which are going to be individual stocks, individual bonds, stock and or bond mutual funds, stock and or bond ETFs or exchange traded funds, and then also real estate investment trusts. And you can even go further down the line, but those are some of the main ones: stocks, bonds, mutual funds, ETFs, real estate investment trusts as well. So those are the individual securities. For those people who don't know, mutual funds are simply a basket. It's like we explain it where in the simple terms, it's a basket of stocks all held in one fund that's managed by a manager based on a certain investment objective. ETFs are structured the same way, except they usually track an index. They're more tax efficient and have most often have lower internal fees as well. So there's individual securities that you want to diversify to. We have plenty of clients that, based on your risk tolerance and your time horizon, hold different stocks, bonds, stock mutual funds, bond mutual funds, ETFs, a bunch of different securities like that. And then another way of diversifying is also through different sectors. So the S&P 500 has 11 different sectors, with those being energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication, utilities, and real estate. So those are 11 different sectors that you can also look at diversifying into as well. And keep in mind, none of those perform the best each and every single year. If you go back and look at different charts, they're all correlated differently. There's never going to be one that performs the best every single year, which is really unique. And that's another reason why it's important to diversify, because right now, if you're all in, most commonly, there's a lot of people that are in the information technology and healthcare. Those are two that are really popular right now, as they should be with the economy where it's at. We're kind of in a tech boom right now. We have a lot of tech stocks. You have your Apple, Microsoft. I'll put Amazon in there, even though they're consumer discretionary. Nvidia. There's a lot of different tech companies and innovation that's really driving the tech market. So they're doing well right now. But if you go back and look, 5 years ago, they might not have been the best performer.
Okay, Tyler, good points. And one other thing I want to throw out there while you're on the subject of these sectors. Remember, the success of your portfolio many times actually takes away some of your diversification. And what I mean by that is, if you have a portfolio and it's going well, especially if certain investments within your portfolio are doing better than the others, congratulations, it's good. You're putting unrealized gains into your portfolio. The statements look good, but realize that with gains that are maybe 5, 10, 15, 20% in certain sectors, and then other parts of your portfolio are flat or maybe even losing a little bit, after a period of time, your portfolio is going to become out of balance. And by becoming out of balance, you actually lose some of your diversification. So we feel it's very, very, very important to go back and rebalance portfolios so you can keep an edge when you're looking at minimizing some of your risk. And the other thing too, when it comes to diversification, people think that diversification means that the portfolio is less risky. Well, in a way it is. Remember, diversification is a method used to help manage investment risk, but diversification does not guarantee a profit or protect against loss in a declining market. If the market's declining, no matter how diversified you are in the stock market, chances are you're probably going to go down with the market. That's why diversification many times goes outside of the stock market into commodities, precious metals, insurance products such as fixed annuities, cash and treasuries, and so on. But I just wanted to explain that a little bit, that the success of a portfolio can knock your portfolio out of balance, which really does affect your diversification.
Yeah, good point there, Dean. So again, we have different asset classes, individual securities, your stocks, bonds, mutual funds, ETFs. Then the various sectors that I just mentioned, those are all three different levels of diversification. But then in addition, we have two more. The next one would be market cap. So you can have either small cap, you can hold a small cap stock fund, a mid cap, or a large cap. And what I mean by that is simply the size of the stocks that a certain fund to invest in. So for example, if you have a small cap stock fund, that's going to be riskier than the S&P 500. That's going to be riskier than the market because it's of smaller companies. They aren't as established, but yet they're poised for big growth potential because they're still in the growth phase. So usually those are going to be much more risky, but at the same time they have more growth potential. Mid cap is in between, or same thing there. They're going to be riskier, but they also have good growth potential. They're more established than smaller companies, but yet they still have much more room for growth as well. And then you also have your large cap stock funds, which those are the most common. Those are the largest of large companies. We see a lot of those on the S&P 500. You have your Amazon, Apple, Microsoft, Home Depot, Walmart, McDonald's, ExxonMobil. A lot of the big companies that you've heard of, that's your large cap companies. And then even to go outside of that, you can also there's also a mega cap, and then on the other end of the spectrum there's a micro cap. But again, that just determines the size of the stocks that you're buying, the size of the stock funds that you might hold in your portfolio. Just another way to further diversify your holdings. And then in addition to that, the last level of diversification would be geography. So which part of the world are your investments located? There's European markets, Central South America, Asia. There are markets all over the world. So international positions can also get you further diversified with international holdings as well as emerging markets. So emerging markets are one of the riskiest asset classes that there are, because those are stocks of companies that are in different markets that aren't fully developed. Because right now the U.S. market, we're fully developed, we're a mature market. We're one of the least risky if you look around the whole entire world, because we're so established, and we have a very large GDP here. Whereas there's companies that are emerging yet, they're not fully established, they're risky because they're not fully mature. They don't have the same businesses that we have here in the U.S. And again, that's another level of diversification, going into different international and emerging market funds. But again, right now, we have clients that are in international emerging market funds, but they're not always going to be favorable. Sometimes we might kick them out of portfolios just because right now international and emerging markets are down 5 to 10% on the year. However, in 2017, they were up 25 to 40% depending on where you were at with the international or emerging market funds. So again, that just shows that you want to be diversified, but no matter where you're at, you're never going to find that asset class that each and every single year is a top performer. You want to make sure that you're diversified in a number of different asset classes.
That's right. And the other thing too is Tyler's talking about, certain asset classes coming in and out of favor. International markets had done well in 2017, not very well in 2018, mainly due to geopolitical issues such as tariffs and sanctions. So as a result of that, you want to make sure that you still take into consideration momentum with your portfolios. In other words, you want to see where the momentum is going around the world or in different sectors, and you want to be involved there. The thing that you have to be a little bit cautious with, though, is chasing the market. Many times we will see people coming in and they'll say, well, why don't we have a portfolio just built on the FANG stocks? Well, it sounds absolutely wonderful in hindsight when you look at what they've done over the last handful of years, but do you realize the risk that you would be taking in that portfolio? And we always make sure that a client or an investor that comes in to talk to us is aware of the fact that many times mitigating your downside will be much more successful over the years than taking big significant gains. Okay, those big significant gains with certain stocks also take big significant dips too. So we want to mitigate those downside. Make sure that you look at diversification and take geography into account. As we said, right now we're very heavy with U.S. based investments only because of what's going on globally.
Yeah, Dean, good point. You mentioned there with the FANG stocks. Many people, like you said, they come in and they say, that the sectors are doing so well. You have your Facebook, Apple, Amazon, Netflix, and Google. If they said, if that's where the money is, why don't we just go and concentrate all our investments there? Well, keep in mind, if we have another 2008 again, you might lose 70-80% of your value if you were allocated only there. So again, you want to diversify. That way you can level out those peaks and valleys, and you're not caught off guard if we have a severe quick market downturn, which would be the case if you were invested fully in FANG stocks. We also had a client who they were in all mid-cap investments in late 2007. The market crashed and they lost 70% of their value. It took almost 10 years to get back to even, and that was from not being properly diversified. So again, being properly diversified, you might not get all the upside of the market. You won't get all the upside of the market if you're invested in different bonds as well. But at the same time, you're not going to be caught off guard if we have a big market downturn where the market goes down 10% and you lose 12%. Usually you're caught off guard a little bit and you're not properly diversified. So again, being properly diversified will help level out the peaks and valleys.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back. What we want to talk about now is overlap in your portfolios. Again, people will come in and they'll have a big bunch of investments in a portfolio thinking that they're fully diversified. And when Tyler and I get down to analyzing the portfolios, we find out that there is such significant overlap, referred to as correlation, in their portfolio that they really lose their diversification. So more isn't always best. Okay, there are many times we'll have a portfolio together, regardless of the amount of money that's in the portfolio, that is made up of 5, 6, 7, 8 different stock positions, a couple mutual funds, and some ETFs. And that gives you a real nice diversified portfolio in certain situations because you don't have that significant overlap. But you really have to be aware of overlap. There are some websites out there that are available to anybody: Yahoo Finance, MarketWatch, Morningstar. If you go in there, you can put the QSIP or the ticker number of your mutual fund or ETF in there, and they will show you the holdings. And you can look at the holdings from one mutual fund to another or one ETF to another to see what type of overlap there is. So make sure that you're aware of overlap within these mutual funds or ETFs. Tyler, what else do we want to talk about when it comes to overlap?
Yeah, Dean, so definitely want to be aware of overlap in mutual funds. Now, and I've seen it, and right now there are quite a few funds out there where there's lots of stock overlap within the funds, causing diversification to lack. For example, there's mutual funds that have 10 identical stocks that represent the largest holdings, so those 10 largest stocks make up 30 to 40% of the mutual fund. And there's a bunch of different funds that have those 10 same stocks that make up 30 to 40%, and that right there is going to cause significant overlap. And what you can do is you can actually go, there's a number of websites out there, like you alluded to, Dean, Yahoo Finance, Morningstar. You can go type in the ticker symbol of your mutual fund, and it will show you, usually it's the 10 largest holdings, sometimes they do the 5 largest holdings. You can see the individual stocks that make up the largest percentage of that fund. And you can go and compare. If you have 5 different funds, you can compare those. And I've seen it before where people have had 2, 3, 4, 5 different funds, and those 10 largest holdings were identical across the board. And that right there takes away your overlap, because even though you have 5 different mutual funds, those 5 mutual funds hold a lot of the same individual stocks, which takes away diversification. So it's one of the biggest misconceptions that people have, where just because they have a number of different mutual funds, they think they're fully diversified, when in reality, a lot of the largest holdings within those funds, so the largest individual stocks, are all the same companies. So again, that will take away from diversification. And like I alluded to earlier, one thing you can do is you can go online, do your research, see what the largest holdings are. We do a lot of research for clients with that. We want to make sure that they're properly diversified, because if you're going to go and get 2, 3, 4, 5 different mutual funds, at the very least, make sure that they're not all overlapped and you don't have the same holdings within there.
Okay, good points, Tyler. We're going to talk now about being overly diversified, too diversified. And what I mean by that is Tyler and I have a term in the office. It's called spaghetti against the wall approach. You throw spaghetti against the wall, some of it's going to fall to the floor, some's going to stick. It's just purely a matter of how much spaghetti you throw against the wall. It holds true with the portfolios. We will see people come in with a portfolio that's put together by an advisory firm or themselves, and they might hold anywhere from 70 to 100 different individual stock positions, thinking that the more stock they have, the better it is for them. Well, I mean, it could be. You've created your own mutual fund, basically. But at that particular time, can you really manage all of the holdings in there? We like to have a manageable amount of holdings in a portfolio so we truly can look at these holdings, get to a point where we know them very well and can follow them. When you're holding too many stock positions, too many mutual funds and ETFs, again, you cannot manage them properly. An investment advisor cannot manage them properly. And chances are it's going to be a pretty bland portfolio. If that's the case, get rid of the portfolio and look at, watching an index. Pick up an index fund if that's the case. But you can be too diversified. Too diversified, again, doesn't necessarily mean, more is better. Have a manageable amount that doesn't have too much overlap.
Yeah, Dean, good point there. And I know the whole show so far we talked about making sure that you're properly diversified, but I think this is actually more common than not being diversified is actually being too diversified. Now, it's, as I said, it's usually actually more common where people come into our office and either they'll have a portfolio that they've set up or an advisor set up for them that it might perform well in up markets, it might hold steady in down markets, but at the same time, they're taking on the spaghetti against the wall approach, as we call it, where they have a little bit of every single asset class, every sector, every geographic location, when here there might be a sector that has been performing poorly for the last 5 years, and all it's doing is dragging down the returns on the portfolio. For example, there's clients who come in and they might have there's a client recently that they had 15% of their portfolio made up of a gold and silver ETF, which for the last 5 years, it had negative returns. And it was in there, as a hedge against the stock market to be diversified, which is okay. But if you go back and look at the last 5 years and it was negative and it's just doing nothing but dragging down returns on the overall portfolio, typically you're going to want to kick that out of the portfolio until that sector shows a little bit more signs of life. So again, if all it's going to do is drag down the portfolio if it's not performing well, it doesn't make sense to keep that in there and keep on holding it, just waiting for it to go positive just to say that you're diversified. So again, it doesn't make sense to be in every single asset class, sector, and geographic location if those investments are performing well. We say usually you want to go where the gains are being made. You want to be with that momentum. Now, you don't want to chase the returns. You want to be properly diversified. Just don't be overly diversified into different sectors and asset classes that have been dragging down the portfolio for years, and there's no signs of life in the near future or maybe even the long-term future. So again, don't want to be too diversified. It's the spaghetti against the wall approach. And what we say is instead of throwing all that spaghetti on the wall, some's going to stick, some's going to fall. You want to try and get as much of it to stick as you can. And with being properly diversified, of course, some is going to fall, but you want to try and make as much stick as you can. And that comes with making sure that we're in the asset classes that are doing well. Again, some aren't going to do well, but you want to go where the gains are going to be made. Okay.
In addition to diversification, too, Tyler and I believe that cash is a very important thing to carry in a portfolio, just about at all times. Okay, there's certain times we want to be all in with certain clients, especially younger clients who have a significant time period before they do retire. They should be all in. However, as we get older, we do believe in carrying cash in portfolios. And what I mean by that is, hypothetically, if you have a $100,000 portfolio, moving $90,000 of the $100,000 into different investments in the portfolio is a good thing to do, but hanging on to approximately 10% in cash is there for two reasons, two main reasons, I should say. Reason number one is to be able to risk manage the portfolio. By hanging on to that cash, you're able to then take that cash and buy your way out of some of these troughs. If the market goes down, you build the cash up while it's high, the market goes down, you can take that cash then and buy some equity positions at a low. They might be beat up. You will have usually a quicker recovery. That's really the main reason. Secondly is sometimes stocks go on sale. And what we mean by that is, especially in today's market, if the earnings report doesn't look good for whatever reason, or it didn't beat by a certain amount that analysts were thinking it should beat, then the stock goes down. Again, it's a good buying opportunity. So we like to carry cash to help risk manage the portfolios. Also, if you are retired and withdrawing from the account systematically, let's say on a monthly basis, we need to have cash in there too so we can do the withdrawals for the clients. But the main reason is look at diversification and also a risk managed portfolio, which is usually indicative of something that holds some cash in the portfolio.
Yeah, Dean, really good point there. A good point to end with today is, like you mentioned, don't forget about cash when it comes to diversification. So again, you have your stocks, bonds, mutual funds, ETFs, but we always want to make sure that we have a portion in cash, as you mentioned, Dean, to be able to buy in or to use it as a funnel and build that up if the market were to get volatile and head downward in a hurry. And the whole, when we have these different actively risk managed portfolios for our clients where we have a cash portion and we're properly diversified, it might be a moderate portfolio where the whole goal is to try and get 80% of the upside of the market. So if the market is up 10%, we hope to get 8%. But yet if the market goes down 10% in any given year, we hope to go down take on no more than 60% of the downside, meaning we'll go down no more than 6%. Now again, you could go down or up more than that based on the market, but if we can try and capture 80% of the downside, 80% of the upside, while taking on no more than 60% of the downside in a moderate portfolio, that means that we're diversified. We can even out those peaks and the valleys, and it'll be a much easier ride, so to speak. So again, don't forget about cash when it comes to diversifying your portfolio.
Okay, that's all the time we have this week. See you later and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.